Hey guys, wanted to take a quick minute to talk through a question that I get from time to time. And it's a question that I think everyone wonders. And that question is, why don't we try to time the market in some way? Why don't we, if we have a sum of money or if we have a rollover hitting an IRA, why don't we wait a little bit to make sure that the market is okay to jump in? Why don't we make sure that the market's where we want it? And what's the downside of just holding off and maybe slowly putting your money in over the course of a couple months? Now, one quick thought on that to begin with. Dollar cost averaging is an excellent thing to do. Dollar cost averaging is a good, healthy thing. But its primary purpose is not for a lump sum of money necessarily. The primary purpose and intent in the purpose or the reason behind dollar cost averaging is the idea that, well, typically you're getting paid every 2 weeks. And with that, you're usually making your 401k contribution. So by default, the inertia of life and how you get paid means that you're dollar cost averaging into the market. And that is a good thing, which enables you to have the mindset that if you're working and if you're currently saving, then it's okay if the market goes down, because that means that every 2 weeks you're going to buy in at low prices. Now, when it comes to having a lump sum, or maybe you are invested and you're still wondering, well, why don't I just pull out right now? I'm worried about what's going on. Currently, what we're seeing over the past couple weeks, we're seeing a lot of volatility, and there's a lot of concerns. Is a China deal going to happen? Are we going to see a significant drop in the market because a deal does or does not happen? And what's the effect going to be? So there's this temptation to either take your money and put it on the sideline for a little bit, whether that's in your IRA or in your 401k, or a temptation if you have a lump sum or a rollover of some sort, or you're transferring assets, to stick it on the sidelines for a while. Here's the danger in doing that. And so I just talked about dollar cost averaging and how it's typically utilized just in a 401k every week, every month type environment. Well, let's pretend you do have a lump sum. The majority of the time, about 70% of the time throughout history, it would have been better to simply invest everything day one. And the reason for that is typically the markets go up. Most of the time, the market is not going down. A good 70-80% of the time, the market is advancing. It's going up. But a couple topics we want to touch on. So with volatility and timing the market, the first thought that we want to look at is we don't know where the market's going. We don't know. And that's okay. It's comfortable. That's not a bad thing, because ultimately no one knows where the market is going. And so one quick illustration there. This is a resource from Dimensional Funds. Huge fans of Dimensional. But when you think about the landscape of mutual funds and professional money managers, it's important to see no one knows where the market's going. And so what this is showing is just simply all of the mutual funds that are in existence as of December 31st, 2018. How have they done over time compared to their index? Because ultimately, in a mutual fund, you're paying. You're paying for the bright mind, the research staff, and a team of people that, in theory, should be smart enough to do better than their index. They should know which stocks to buy, when to buy them, and when to sell them in order to do better than you could do if you simply bought a Vanguard index fund. And what this shows us is nothing new, but it's just more of the mountains of evidence that tell you that beating the market, beating an index, is incredibly difficult. And so over the course of the last 10, 15, 20 years, not only have very few of these, a small minority has beat their index, but almost half of them don't even stay in business. And so you think about that happening, these mutual funds, they're performing so poorly that they're not even open 10 years later. They've closed their doors, and you don't close your doors because you were doing extraordinarily well. Another point with this, when you look at a typical mutual fund manager, a lot of mutual fund managers are incredibly bright, Ivy League educated. They have all the advantages that you could possibly have, but the markets are very efficient. A 15-year-old in Bangladesh has access to the exact same information as the highest paid analyst at Goldman Sachs. And so we don't know where the market's going. So we don't want to try to time the market. Now, even if we don't know, there's still a temptation. What if we're right? What if we do? What if we do happen to be pulling back or holding our money out of the market at a time when it is going to crash, and then we can take advantage and buy in? Well, the danger there, Fidelity did some incredible studies, and over the course of the last 4 decades, had you just invested $10,000 in 1980, take a look at this. $10,000, 39, 40 years later, we're looking at over $700,000. Unbelievable example of compound growth. But over the course of time, compound growth can also have an incredibly negative effect if you miss out on it. And so missing simply the 5 best days in the market scattered over the last 40 years, it takes away almost half of your gain. A truly unbelievable. Missing the best 10 days, that actually is about half. Missing the best 30 days, best 50 days. So missing significantly positive days in the market is a big deal. Not just because you miss that one day, but because you always have to deal with the effect of compound interest over time. So missing a really positive day in the market right now, not just, it doesn't just hurt your returns this year, but that's a significantly positive day that you're not going to see compounded over the next 10, 15 years. And remember, we don't know when those days are going to happen. No one knows when those days are going to happen. And so making sure that the old saying, time in the market. So time in the market over this 40-year period is much more important than timing the market or trying to guess which days are good or bad. So we don't know. No one knows. Next thought, when markets move, it's not always a simple gradual process. What do I mean by that? So what's interesting when you study bear markets, so when you study market crashes, the average up day and the average down day is significantly more emphatic in a volatile market than a non-volatile market. So when we're in the midst of a market crash, obviously the down days are bad and they're significant. Average down day is over -1%. And when you think about how many days there are, having an up or down swing of 1 to 2% in a single day, that's a big movement. And so during a bear market, obviously those down days are significant and those are bad. But what most people don't realize, the up days, the positive days in the middle of a market downturn are also really positive. And so not just are the down days more emphatic than usual, but even the positive days, even though the market's crashing, the positive days on average are about a plus 1.2%, which again, for any individual day, 1.2% is an enormous gain for an individual day. And that is what is the average update during a down market. And so we like to think, well, what if I just stay on the sidelines? What if I hold my cash until the market calms or normalizes, whatever normal means? But the difficult truth about that is markets don't normalize. Markets don't move in a peaceful, gradual pace. And this graph is an unbelievable piece of evidence towards that. Simply missing a couple of the best days is a big, big deal. Because sometimes those really good days are in the middle of a market downturn. And so we don't want to try to guess the days. Guessing the days is a losing proposition, and it's incredibly difficult. One other thought here. 2 other thoughts. First, all-time highs, so you hear in the news a lot, the stock market reaches an all-time high. You might see the president tweet how great it is that his stock market reached an all-time high. Now, all-time highs are not a reason to get worried. All-time highs do not mean that it doesn't mean that we're at a top and we're about to see a big drop. All-time highs happen all the time. Several times a year, we see new all-time highs, and that's not a bad thing. This is another piece of research from dimensional funds. So average annualized returns after new market highs. So think about what this is saying. So this is when the market reaches a new record. So stocks have done so well, we've reached a record price. At that point, there's a temptation to say, whoa, all-time high, let's pull back. Let's go to cash. Let's take a safer position. We've reaped our gains. It's time to run for safety. When in reality, the average return for the next 12 months, so the next 12 months right after we reach that record, unbelievable results. And so this is over almost a 100-year period. The next year, compound return on average, after reaching a record high, over 14%. The next 3 years. So it's not even that just 1 year is positive. The next 3 years are still double-digit returns. Next 5 years, almost 10%. And so don't get worried about an all-time high. All-time highs happen all the time. And all-time highs also happen in every other facet of our life. The cost of rice-a-roni 25 years ago was at an all-time high. And people are still eating rice. The cost of everything continues to go up. And this ties into a simplified example there, but it ties into this last point. Remember what you're investing in. We're not investing in something that once it reaches a record high, it's about to crash. Because we're not investing in the government. We're not investing in a political policy or a news headline. We're investing in the greatest companies in the U.S. and throughout the world. We're investing in companies that they're going to wake up tomorrow morning, regardless of what the newspaper says, regardless of what's on CNBC, regardless of what the president tweets, regardless of what's happening, Google, Facebook, Alibaba, Amazon, Nestle. These are companies that are going to wake up tomorrow and they're going to find ways to win. And so that's what we're investing in. We're taking a vested ownership in their success. We're not investing in geopolitical events or different concerns around the world. And so those are a couple reasons to make sure that we try to stay away from trying to time the market, and some thoughts on volatility.